Welcome back to the Fund Financing Podcast. In this new episode, we will focus on the earliest form of fund financing, subscription lines, also known as capital call facilities or equity bridge facilities. My name is Delphine Gomes and I'm a counsel at BSP. I'm here today with Rashida Benhalima, counsel at Simmons & Simmons, Yves Wampach, representing the lending and fund financing desk at Spuerkeess, and Pierre Even, Secretary General at Banque de Luxembourg. With this in mind, Rashida, could you please remind us why Luxembourg is considered as an ideal jurisdiction for structuring fund financing and in particular subscription lines?
Well, thank you very much, Delphine. So Luxembourg is definitely a sweet spot for fund financing. As a reminder, we are the second largest investment fund center in the world, managing over 5 trillion in assets under management with investors from all over the globe. That international reach means lenders and sponsors are already comfortable with our structures. Legally, we have a very strong framework. Our financial collateral arrangements law lets lenders take robust and foreseeable security in a way that's both flexible and bankruptcy remote. Over the years, the market here has grown not just in size, but also in complexity, as we adapt to different fund profiles and investor needs. And it's just not Europe and the US anymore. We're seeing more deals coming from Asia and even a growing domestic Luxembourg market. And we are seeing more and more alternative lenders. On top of that, we've moved from plain vanilla subscription lines to a full menu of liquidity solutions. So, from deep investor pools to lenders' familiarity and strong legal tools, Luxembourg really does tick all the boxes.
Thank you very much, Rashida. That was an helpful introduction and it provided valuable context for the development of this type of financing. I propose that we now delve into the technical aspects. To begin, Pierre, how would you define a subscription line? And what are the purpose and added value of this type of fund financing?
Thank you, Delphine. Let me start by setting the grounds in terms of wording. For this podcast, we will commonly refer to subscription lines or sublines. Other synonyms commonly used would be subscription credit facilities or equity bridge facilities. They in fact all refer to the same instrument. In simple terms, a subline is an instrument allowing a fund to very rapidly deploy cash that is provided by a lender, in most cases a bank, and secured by the uncalled capital commitments of the investors of the fund. A traditional capital call involves multiple parties. A decision to issue a capital call must be decided and documented, then the administrator of the fund notifies the investors. Depending on the arrangements of the fund's documentation, you may generally see a delay between 5 and 10 working days from the notification to the payment deadline. As such, between the moment you decide to issue a call and the moment all the funds are at your disposal as a manager, we talk multiple days, often up to a few weeks. This can be too slow if you're facing an investment opportunity. The subline, once in place, can be done without any notice period. This allows the investment manager to be extremely reactive in seizing investment opportunities. Furthermore, all the administrative steps surrounding the subline have been tackled beforehand. Using the line, once it's in place, equals to just instructing your bank to execute a wire transfer.
Thank you, Pierre, for that excellent introduction. Yves, as fund finance is a significant aspect of your day-to-day practice, have you observed any notable changes in how your clients have used this tool over the past 10 years?
Thank you for the question, Delphine. And yes, indeed, there are also several studies about this trend. So, for instance, Investec conducted an interesting study looking at the frequency of capital calls made by funds each year, and the data revealed a notable trend. In 2015, funds averaged 4 to 5 capital calls annually. However, this number has steadily declined, reaching just 2 calls per year by 2021, so a notable decline. On the other hand, another study explored the use of sublines to finance capital calls. In the year 2000, fewer than 10% of funds had a subline place. This figure surged to over 50% by 2016 and to over 75% by 2020. So this shift partially explains the reduction in the number of capital calls.
That bodes well for the next 10 years. Yves, could you share your insights on the key reason why funds are striving to minimize capital calls and are increasingly turning to subscription lines?
So a subscription line offers significant advantages to both private equity funds and their investors. In general, a subline makes the investment process smoother. Typically, when a fund identifies an investment opportunity, it must issue a drawdown notice to investors and wait for the capital to be provided. In a competitive market, timing is crucial. With a subscription line in place, the fund can invest immediately using the facility without waiting for cash from investors. This advantage leads to several other benefits. Some funds hold large amounts of cash to ensure they can react quickly to potential investment opportunities. So what do? They call investors and let the cash sit in an account until an opportunity rises. During this time, the cash is inefficiently invested as it needs to remain liquid, which reduces returns from both the fund and the investors. Putting in place a subline eliminates this efficiency. Another advantage is the reduction of administrative tasks. Each capital call triggers a range of administrative tasks. These tasks are not only time-consuming, but also costly. By reducing these tasks to a minimum, funds can save on manpower and costs, allowing more time to focus on strategic decisions. On the other side, investors also benefit from a subscription line, and they don't need to keep large sums of money readily available at all times, because the fund can draw cash from the facility whenever required without needing to approach investors each time with a capital call. On the contrary, the fund can coordinate with investors and schedule annual capital calls. This way, investors know exactly when they will be called, allowing them to manage their cash flow efficiently. To illustrate the last advantage, I give you a concrete example. In January, the fund identifies an investment opportunity. Instead of calling investors, the fund uses the facility. By the end of December, so nearly a year later, the fund issues the drawdown notice and investors provide the cash. By the time investors contribute, the investment has already been performing for nearly a year. This shortens the time investors' capital is tied up, thereby optimizing the internal rate of return. On top, investors were able to invest that money somewhere else during that year, generating an additional income. So as you can see, sublines offer numerous advantages for both the fund and the investor.
Thanks a lot, Yves. That was very clear. Rashida, could you please now explain how lenders typically secure this type of financing?
Sure, Delphine. In Luxembourg, the typical security package for a subscription line is very straightforward but very effective. You usually have two main security, one over the investor's uncalled commitments and one over the collateral account on which these commitments are paid. Both are governed by our financial collateral law, which again is very lender friendly. If you got a more layered fund structure, let's say a master fund with feeders, we usually use what's called cascading security, if the feeder cannot grant security directly to the lender. This is for regulatory reasons, such as ERISA for funds with US investors. A pledge over the feeder's rights to call that capital is granted in favor of the master fund, which in its turn will grant a pledge directly to the lender. And this security granted to the master fund will catch the security granted by the feeder as an accessory to the secured claim. It's a belt and braces approach that makes sure the lender can always reach the subscription proceeds, which are mainly at the level of the feeder fund. When we do the legal due diligences, we check carefully the fund documents, subscription agreement, and any side letters to make sure those commitments are enforceable and free of hidden defenses. And if need be, we can adapt the finance document accordingly.
Thanks so much, Rashida. That's very helpful. Now that we have covered the legal technicalities, Yves, could you please explain how a subscription line operates from a financial perspective?
Yes, I'd be happy to give an overview of the key terms. So the most complex part is likely defining the available limit of the facility. We typically determine this by setting 3 sublimits. So the first sublimit is a certain percentage of the total commitments, as outlined in the fund documents or defined by the bank. The second sublimit is determined by the bank and represents a certain percentage of the total uncalled commitments. This percentage is based on the quality of each investor. For instance, we will allocate a higher percentage to an insurance company with a AA rating than to a small unrated company. Finally, the third sublimit will be a maximum amount that the fund might require and which must be agreed upon with the bank. Now, to determine the available limit, we calculate the three sublimits, and the lowest value among them defines the available limit at that specific time. It's important to note that as the total commitments and the uncalled commitments change over time, these sublimits will also change, resulting in a variable limit. Another important term is the duration. Subscription lines typically range from 1 to 5 years. Naturally, most funds prefer the security of longer-term commitment from the bank. Regarding fees, we usually see for the drawn portion a reference rate, such as the 3-month Euribor plus a margin. For the approved but undrawn portion, a fixed commitment fee or non-utilization fee is applied. Additionally, an upfront fee is charged. The pricing of these components depends on various factors, including the quality of investors, the fund's track record, and the overall risk of the application. Finally, there is the clean down requirement and rest period clause. For example, if a fund has a facility in place for 3 years, it could potentially draw on the facility for 3 consecutive years. According to AFMD, such a facility must be short-term to avoid being classified as leverage. Therefore, the exposure must be less than 364 days. To comply with these leverage restrictions, we introduce a clean down requirement and a rest period. Clean down means the fund must reduce its exposure to 0 within 364 days. The rest period means the exposure must be 0 for at least 1 day. We as a bank will also closely monitor this and inform the fund as the 364-day deadline approaches. But I think it's also important that the funds understand the reasoning behind this requirement.
Thank you very much, Yves. Rashida, I believe you also wish to share a few words regarding the leverage restriction under AIFMD, which most funds are subject to.
Sure, Delphine. Under AIFMD, leverage is defined quite broadly, so a subscription line can easily fall within it unless you structure it carefully. The key thing is to make sure it is not seen as a temporary financing under these rules. And as mentioned by Yves, that's where the clean down comes in. Fully repaying outstanding loan within 364 days of each drawdown is key. Some funds even clean down more than once a year, which makes it very clear that the facility is just a short-term bridge. We also make sure that loans are not rollover, meaning that a loan will not serve to pay the preceding loans. That's important not only for you as lender to stay within the rules, but also for how you present it to your investors.
Thanks so much, Rashida. Pierre, Yves, would you like to add any closing remarks?
Thank you very much, Delphine. To sum it up, the obvious conclusion is that a subline is a beneficial instrument for all involved parties. On the one hand side, the fund manager gains flexibility when it comes to seizing investment opportunities. On the other hand, the investor faces a lower number of capital calls and shortens the time its capital is tied up, ultimately optimizing the IRR. The Luxembourg Fund Center has continuously evolved over the last 15 years. As mentioned by Yves earlier, statistics clearly confirm the more systematic use of sublines by fund managers. I can only encourage those managers who do not yet benefit from these instruments to reflect on it, seek advice from their legal counsel, and explore the possibilities offered by their banking counterparts. Adding sublines to their toolbox is definitely worth seriously considering.
Thank you very much, all. As we have seen, this is a highly technical topic, but we now have a much clearer understanding of what a subscription line is and how it operates. It will be interesting to compare this type of financing with NAV facility, which we'll be discussing in our next episode, so stay tuned.